Hey, isn't it amazing that nearly anyone can invest these days? You can do it right at your fingertips, even on your phone. And now, if you think about it, this wasn't possible not a few years ago. But does this necessarily mean that everyone gets equal opportunity to wealth? Or will the rich, with more access to specific products, continue to get richer? Welcome back to the Money Talks podcast. I'm Andrea Heng, and today we are going to pick up some nifty lessons from wealthy investors and see if that can apply to the rest of us. To help us with that, sitting in the hot seat on the Money Talks podcast today is Sheryl Choong, Head of Client Advisory at Endowus. Welcome, Sheryl.
Thank you, Andrea. Thanks for having me.
It's great to have you here. So, the old dividing line in investing was access to products, right? But there seems to be a new divide emerging from our observations that people get access to more complex financial products.
Yes, I think you have already pointed out that, now there are complex products like private market funds. They are being available not just to the traditional, institutions, endowments, family offices, or even ultra wealthy. Now, more investors are being able to invest in these funds that we're talking about. So the problem that we're facing now is not so much about access, because that has already been somewhat solved by wealth platforms such as ourselves, right? So now the problem comes in that how are these investors, do they have the necessary tools or knowledge and also the necessary advice given to them to navigate these complexities? I think that's a key, issue here, right? And because without these clear and, aligned advice, I would say, more often than not, instead of feeling empowered by these variety of options now, what happens is that they will face confusion, and also it will lead to, decision paralysis, unfortunately.
Yeah. Or even worse, mistakes.
Yes, that's right.
Yeah.
So what we will see is that even though, if they don't have this advice that they need to have, what often happens is that even if they invest, when market has a downturn or where there's a slight blip in the market, for example, what happens is that they will not, they will want to sell these investments, or they'll question why are they even holding on to these.
It's one thing to have access to these funds. It's quite another to learn how to navigate and manage them and know what to do with it, right?
Yes.
Okay, so over the past few years, our population here in Singapore of high net worth individuals has grown steadily. I mean, we hear it in the news, we read about it, sometimes these rankings of how many billionaires there are in Singapore, etc. Now, these people have worked hard to cross the financial threshold, right? And then suddenly they have this world opening up to them of complex products like private equity and credit open to them, right? So what in the first place is private equity and what is a private credit fund?
The easiest way to explain this is how to compare it against their public peers.
Okay.
Right? So private equity is basically holding a share into a privately held company as compared to public equities, whereby it's listed in the exchange and you can buy on exchange and trade it daily, for example. Private credit is a similar concept. It's public peers, which is public fixed income. It's basically, public debt that you can actually buy, not via the exchange, but it is traded over the counter, for example. And you can also buy from market exchanges.
Okay.
As compared to the private peers, that's where it's privately negotiated debt. With like the companies individually.
Okay,
Yeah.
okay. So before I get into how to navigate all of that in the first place, why do some of these wealthier investors use these tools? What's the benefit for them? What's in it for them? And why aren't these available to the rest of us?
So there are a variety of reasons why investors want to invest into private markets, which is private equity, private credit, and actually it goes beyond that, private infrastructure, for example. And the reasons is because it provides diversification, away from their already public portfolios.
I see.
And it also provides a lower volatility. So because it's not daily traded compared to public markets,
Right.
So it's not as volatile as its
Right.
public markets. And it also provides better risk-adjusted returns at times. So there are many different reasons as to why, investors would want to have exposure into these instruments.
Okay.
Yes.
But why isn't it available to the rest of us then?
So actually, which is back to what we have pointed out previously, it is getting increasingly available. But of course, right now it's to accredited investors only.
Okay.
And that's because of the complexity involved. And it's also part of regulation.
Okay.
But there are two shifts in the industry, I would say, that has been happening.
Okay.
The first thing is, the minimums for these investments traditionally was easily, I would say, 5 to 10 million
Oh,
USD.
right. Okay.
But right now, through wealth platforms, you can actually invest as low as 50 to 100,000.
Okay.
Yeah.
All right.
And another thing is that, fund managers are also coming up with structures, what we call evergreen structures, to make these vehicles more liquid and more investor friendly.
Okay.
Yes.
Okay. So that is, I do notice that a lot of this access is opening up to regular everyday investors, such as myself, for example, right? So you talked about the complexities involved, and that's why they're only made available to accredited investors, as you say. What are some of these complexities, if you can give us examples, and what's the advice that you have in terms of navigating these complexities?
I think the complexities, asset class aside, right, which is what we explained earlier about public versus private, there are other things to consider, like the liquidity profile, because they're not daily traded. They tend to be semi-liquid or even illiquid. Semi-liquid meaning it can be quarterly traded, or you will have a monthly pricing, but in order to get out, to redeem out of it,
Right.
sometimes there are, liquidity gates, there are considerations, there are lockups to be taken into account as well. So that's why we always talk about private markets as having what we call illiquidity premium, because they are supposed to pay you a bit more premium as compared to its public counterparts because of these reasons. Right. So the suitability of the funds in your overall portfolio is very important, which is why we always come back to say that it's important to have conflict-free advice, because sometimes, when we speak to clients, for example, and they're interested because they read on the papers and say, oh, I've heard about private credit and I'm interested in it. Right. I hear about private credit equity, for example. But when we speak to them and understand what their investment objectives are, their goals are, then we realize that, hey, actually, the solutions available in the public markets are sufficient to meet your goals.
Okay.
And you don't exactly need to have these complex products.
Right.
So it's not necessary to say that you always need complex products. It's not a one-size-fits-all kind of solution.
Yeah, I agree. And I think you hit the nail on the head there when you talked about suitability to your portfolio, because, understanding the necessity of it, I think, comes with the territory as well. So that's the situation for the wealthy. We have a better understanding now of public versus private, what's available out there, and that there is access to some of it, just not everything. And it does need quite a fair bit of navigating and advice. But why should the rest of us, we are focused on building our CPF, hitting our full retirement sum and that sort of stuff, growing our savings. Why should we be bothered by what this top 1% are doing?
I would say it's not so much about focusing about what the top 1% are investing in. I would really focus or shift the focus to really what brings about, clear investment outcomes.
Okay.
And that ultimately comes to, for the everyday investor, it's about as simple and foundational as, what we call goal-based investing. And firstly, identifying what your investment goals are, because that will then determine, what kind of time horizon you have for these investments, and also the necessary risk tolerance in order to invest. And then only that sets your asset allocation, which then moves on to, the question a lot of people want to ask themselves is what to invest in. But these are the foundational steps that people should focus on before they even focus on, what the 1% is investing
And everyone
in.
should be doing this either
Yes,
way.
that's right.
That's the foundation.
Yes, and the most effective investors, honestly, take into account CPF, because CPF is a very important part and a key cornerstone of our retirement planning. So the most effective investor will then look at not only CPF but also SRH and also their cash investing holistically in their whole financial plan.
Yeah. So it's not just about, we shouldn't be obsessed with, what are the wealthy ones doing that we're not? It's the same rules apply.
Yeah, so I think this divide is not so much about, sophisticated versus unsophisticated investors,
Right.
I think. It comes down to investment behavior.
Right.
So one quote that Warren Buffett actually famously said in one of the interviews, which I really like, is that he was saying that people invest or people get interested in something not because it's going up, not because they understand it, but because the person, the next door neighbor or the next door person to them, who they deem is not as smart as them, is getting rich. So that really shows the psyche of every human behavior,
The
every
FOMO.
investment. Yes,
Yeah.
the FOMO mindset and the
Yeah.
need to always chase trends and chase short-term behaviors
Yeah.
and not be able to, cut out the noise, I would say. So it's correcting this investment behavior and having a true plan. Setting your investment plan and sticking to it is very important. Ensuring that, aside from setting aside, for example, your rainy day funds, every other funds that you have from your income should be properly invested according to whatever your different goals are.
Yeah.
Because that is the only way that having a globally diversified portfolio and investing consistently and then quietly letting markets compound.
Yeah.
I think that's the best way.
Yeah.
Versus trying to chase the next trend, the next market trend, and trying to market time. It's a notoriously tough thing to do.
It is.
Which
I think
is-
even the traders themselves don't find it fun.
professionals find it very tough.
Yeah.
Like to stock pick, to market time is very difficult.
Yeah.
And I think one interesting thing, actually over the past week, I met up with a client who is
Yeah.
a portfolio manager.
Okay.
And so I was there with her family, and she interestingly said to her family, we should have a recurring investment plan.
Oh.
Because that's the only way that you can take emotions out of investing.
Yeah.
And it was so powerful because it comes from a professional herself
Yeah.
telling her family members that is the way to go.
Yeah,
Yeah.
I think so too. And it's something that we hear a lot on the Money Talks podcast too, right? We have a variety of opinions, but time in the market rather than timing the market is this adage that just keeps playing on and on. And it's for good reason. I mean, the
Yes,
Oracle
yes.
of Omaha does not lie. And he doesn't chase trends. And there must be a
Yes.
reason he's made all this money in his lifetime, from starting from so little, and because he knew not to chase trends. And
That's
there
right.
must be value in that lesson,
Yes,
right?
definitely.
Like you said, it's investment behavior at the end of the day, right?
I think it plays a huge part. I would say use the tools that are available to you. If public markets is the only option available, then use that, because in the public markets you have access to ETFs or even mutual funds that will be able to give you you're able to construct globally diversified portfolios based on that. And you're even able to build portfolios like income portfolios depending on what you require.
Sure, yeah.
So of course, if as your universe expands and there are other considerations involved, yes, then you can then explore what is out there to then see whether it fits into your overall investment goal.
Yeah.
But I would say public markets itself already has a wide variety of tools
Yeah.
available, more than any investor can.
So you don't have to
you don't
FOMO
have to
on the
FOMO.
private market.
Yes. But if you have access to it, then yes, explore, understand.
Yeah.
Doesn't mean you need to get into it, but I think the important part is seek clarity in what you're holding on to. I think that's
Yeah.
very important.
Say someone like me who decides, okay, I'm fine missing out on private markets. I don't think I'm missing out on private markets. I'll go ahead and tap on whatever's available out there in the public domain. Can I still attain financial success, a decent, more than decent wealth accumulation through investing in stuff like ETFs and REITs? Can I still attain that level of wealth that I have in my head without tapping onto the private markets?
I think it's two-pronged. It depends on what your target is and
Sure.
whether that target's realistic. I
Yeah.
think that's also the conversations we always have with our clients. We always ask them, okay, what goals are you trying to achieve?
Yeah.
And they will tell us, oh, okay, my retirement goal, car goal, home goals. And then we'll map things out for them based on what you currently have, based on your income.
Yeah.
How much do you then need to invest on a monthly basis or right now? How much do you need to accumulate in order to meet those goals, right? And if the goals sometimes can be lofty.
Yeah.
And that's where financial plan comes in. Us as advisors have to come in and say, hey, the goals might be a bit too lofty. There are two ways to do it. Either you invest more or you have to cut down on your expectations, right? So financial planning aside, The short answer is yes. As long as you have market exposure.
Yeah.
And you invest according to your risk tolerance, because that's important. You don't want to be, have a knee-jerk reaction whenever markets drop 5 to 10%.
Yeah.
As long as you have those foundational, plans in place, and you just keep investing and keep staying in the market, as you mentioned earlier, and ultimately just let markets compound for you.
Yeah, let your money work for you. Let the markets do the job.
Yes.
You brought up a good point about how you have different milestones in your life that you will always. It's almost a guarantee that you will have to adjust your portfolio allocations when these milestones in life happen, right? So let's cap off with a final piece of advice here, Cheryl. What's one practical step or one mindset shift that Singaporeans should consider today to ensure that they are on the right side of this new knowledge divide and that they are prepared for the future of building wealth, that they're not drowning in all of this noise and they still know the right thing to do?
I think the mindset shift should be the questions they're asking themselves.
Oh, good one. Okay.
Yeah, it shouldn't be what should I invest in? It should be why am I investing in, right? It's seeking clarity really in your investments and why you're invested in them. So I think now, start of the year is the perfect time. A lot of people are looking at their portfolios. It's time to take stock.
Yeah, literally,
right?
yeah.
Literally. Think about it. Think about what your life goals are, your investment goals are, and look at your investments. Are you invested in a way that is working towards those goals, right? It's a question to be had.
Yeah.
And it's also important to stress test your portfolio because, when markets are up, everyone is happy to take the most aggressive portfolio, invest in the most aggressive investments.
Everyone's feeling brave all of a
Everyone's
sudden.
feeling brave. But when market turns, it's where everyone starts to panic and starts to, wonder why do they have those investments, and they will start to, cut loss.
Yeah.
And that's where that is a pure indication that you're just not investing according to your risk tolerance, for example. So a few things I think to cap this off is really invest with clarity.
Yeah.
Seek conflict-free investment advice, and really stay in the course.
Okay. What's the best piece of advice you got when you were trying to allocate your investments when you first started?
Not to market time.
The Oracle of Omaha's advice rings true decades
true.
later. I think it's a very nice note to end on. Cheryl, thank you so much for painting this clarity for us. I think really the takeaway for me here is there's no reason to fear missing out on private markets. They're there, they're available, but you don't always have to access it just because. You can still earn a more than reasonable wealth accumulation with whatever is available out there. So thank you for clarifying everything for us.
Thank you for having me.
And thank you to our Money Talks community. Thank you for tuning in as always. But we now want to hear from you and what you think. We talked a lot about closing the knowledge gap here today. What is the one financial topic you now feel motivated to learn more about? We can facilitate that here on the Money Talks podcast. All you have to do is send us a message on wherever you are listening from, or you can email us directly, cnapodcasts@mediacorp.com.sg. I'm Andrea Heng, and I'm signing off for the Money Talks podcast.